Let's talk about the S&P 500 here. Let's talk about the stock market. Let's talk about whether or not we're in the beginning of a market crash, what we can expect going forward. Obviously, with Jerome Powell, he had his rate cut decision of 25 basis points. That's not necessarily what sank the market. What sank the market was the fact that there's not going to be as many rate cuts in 2025. So the market's reacting to that, the prospect of a higher inflation in 2025 as well. So where do we stand with the S&P 500 right now? What should we be worried about? What should we be concerned about? For right now, the key point for the market in this point of time is this support level right here. So you have this huge support level going back to October. And I say huge, it's not like necessarily a multi-year support level, but it is something that there's been a lot of support at. And it's not necessarily a to the penny kind of a support level. It's more or less like an area of support that we want to be watching here. So on SPY, and we'll tidy this thing up a little bit, but you have an area of support from about 585 all the way up to about 586 and a half, 587. And right now, that's where price is sitting at. So you had the huge sell-off yesterday. I do think it was a little bit of a concern today that despite the fact that the market is actually getting pretty oversold. You look down here on the stochastics, it's oversold, and we'll get into some indicators as well that will show you that it's sold. What we have seen of late is where the S&P 500 will dramatically bounce after a 1 or 2 day sell-off. Oftentimes, it's just after 1 day. Here, we tried to bounce today, but the sellers remained in control all day long, and it happened right at this 50-day moving average. We gapped just above it, but then we pushed it down back below it. And the selling, every time there was an attempt to bounce this market, here on the 5-minute chart, you can see every time there was a bounce, we were met with immediate selling. Here again, we bounced for close to an hour, immediate selling. So it never was able to get off the ground. And then you're closing at the lows of the day. It's not a good look. But again, I do think that we're short-term oversold. What I would like is for the market to actually make a little dead cat bounce here that I can capitalize off of, and then start to stall out here, maybe around in this area up here. So if we can get back up into like this area, maybe at the low end of this circle, we get up here and we start to stall out, that could be a really good shorting opportunity, maybe using like a inverse ETF on the S&P 500. Ideally, that's what I would like to do. But for right now, there's no way I'm going to short this market that is actually oversold, even though the selling is only appearing on the S&P 500 for the first time since yesterday. Prior to yesterday, we had been essentially consolidating at these highs here. We weren't moving off of those highs at all. And then all of a sudden, following the FOMC, it's like we got like 3 weeks of selling within an hour and a half. And so we're getting a little bit of follow through today. But look at some of these charts here, and this is what will explain a lot of my thinking here. This is the T2108, members of the trading block. I show this chart to them all the time. We're always talking about it, but this is something that shows you the percentage of stocks trading above their 40-day moving average. We're at 18% right now. Only 18% of stocks are trading above their 40-day moving average. It means 82% of stocks are trading below it. Historically, that is incredibly significant. It's below the lows from April of this year, and April was the most amount of selling that we've seen all year long. And we're below that level right now. In April, we only got down to 21%. Right now, we're sitting at 18%. Go back to the sell-off back in October and November of last year. How low did we get? We got down to about 12%. So we did get pretty low at that point. We're not quite there at that moment yet, but it took us about a solid 2 months of declines on the T2108. You relate that back to the S&P 500 during that same time. There was a good deal of selling that took place going from about August to October, and it took place over time. This right here, this happened over a course of a few weeks, but on the S&P 500, you don't see that 3-month decline that took place. Instead, it just happened over the course of 1 day. So I think that there is definitely, in order to essentially like equalize or recalibrate this market, there needs to be a little bit of a dead cat bounce. Now, why is it that this never appeared in the S&P 500? That's because you have stocks like Broadcom, AVGO, that went straight parabolic prior to just 3 days ago. I mean, it goes from 177 all the way up to 250. That's a massive move. And then even more so, Tesla, which is up in less than 2 months, up over 128% at one point, going from right here, the lows of October 23rd, all the way up from 212 to 488 or so. Yeah, 488. That is a massive move. And it's going to hide a lot of the weakness. But it wasn't just those two. Obviously, you have NVIDIA, which has been struggling over the past month or so, but it hasn't broken down. You have Apple that's been going ripping higher. You have Microsoft that's been ripping higher. And then you have Google doing the same thing, Amazon doing the same thing. So you have this huge support from over $10 trillion worth of stocks that really haven't sold off. In fact, if anything, they continue to push higher up until 2 days ago. And it was 2 days ago that it started finally showing up on the S&P 500. So what you have in everything else, though, is a picture that's very similar to what you're seeing with the Russell 2000, where we have been consistently selling off with the small caps, with stocks that are not in tech, that are not in discretionary, that are not Amazon related. Those stocks have all been selling off for quite a while now. You can also see it in the Dow Jones. I hate quoting the Dow Jones, but it does show you a good picture of it, where it went down for 10 straight days, barely missing an 11th straight day to the downside here just today. So things are already extremely oversold. They're just not oversold with the mega cap plays, with Broadcom and Tesla and Google and Amazon and Apple and Microsoft. Everything else, it is oversold. So going back to T2108, it explains why we're at this 18% level, because it's been taking place for a long time now. If you go back and you look at 2022, where we had, a major decline that year in the stock market, what was the lows that we reached there? Like 7-8%. That tends to be where, when you get it like into the single digits on the T2108, where there's some really good long-term buying opportunities. We're not that far away from it. I don't think we get there. I could be wrong, but I think in order to get there, we need a little bit of a bounce out of this market first, just to recalibrate everything. So then we can go ahead and essentially let's look at another thing here. T21-2. This is the percentage of stocks trading 2 standard deviations above their 40-day moving average. We're at 1.67. Guys, this is about as low as it can get. I mean, you really can't go, you definitely can't go below 0 on it. And we're at same levels that we were seeing in 2022 practically, when we were like just barely below 1. And we're at 1.67. That's the lowest reading that we've seen since April of this year. And it's on line with what we saw when markets were bottoming back in 2022 as well, at those levels, as well as in like October too of last year. Let's flip it around, though, and let's look at stocks that are trading 2 standard deviations below their 40-day moving average. Look at this. 55% of stocks are trading 2 standard deviations below their 40-day moving average. Again, that's way more than what we saw during the sell-off in April, and it's starting to get closer and closer to what we saw back in October and November following a 3-month sell-off. So we're at a stage here where it would make sense if we saw some kind of a bounce out of this market. Does the market necessarily have to do it just because it would make sense? Absolutely not. But from a reward risk standpoint, I feel much better about getting long at this level than I would getting short at this level, because I do think that getting short at this level exposes me to a potential dead cat bounce, and I don't want that. But in any case, what I wanted to do is I wanted to sit down and show you some of the things that I was looking at here, some of the indicators and some of the logic behind my thinking right now, that I want nothing more to get short on this market. I would love to get short on SPY, but this isn't the time and place to do it here, because we're already overextended even before we got this major move to the downside on SPY. We were already seeing a heavy sell-off, so that to get short on this market now just doesn't make much sense to me. It's better to wait for this bounce, a relief rally, and then to try to get short if the opportunity provides itself with that. If you enjoyed this video, and I hope you did, make sure to like and subscribe, and leave me a comment down below. Let me know what your thoughts on this market. Do you think we have much more to go before we get any kind of a relief rally, or do you think that we're going to dead cat bounce here and potentially see maybe we get like a 2 to 3% rally here? That could be a nice little trade there. In any case, make sure to check out shareplanner.com. That's my website. And thank you guys, and God bless.